Hi, this is John Crypto. Breaking. In just 7 days, 26% of the silver that was registered with COMEX went missing. It's not there anymore, not reclassified, not rotated. They just went away. They want you to believe that this is a normal market with a lot of things for sale. Don't blink. Put the numbers on the screen. The inventory on the COMEX went down by 26% from last week. In a few hours, silver goes up $12 and then disappears like a magic trick. The price of Shanghai is between $124 and $125 an ounce. What is the price of spot in the US? $108. The price of India is between $103 and $108. That metal is found all over the world, and the prices can be very different from one continent to the next. In a market that they call liquid, here's the kicker. That's statistically impossible unless something is wrong or someone is lying. Now put everything together. If silver is supposedly everywhere, vaults are full, and supply lines are fine, why is registered silver, the only silver that really backs futures contracts, losing value faster than it has in years? Memes don't make you lose 25% of your deliverable supply in a week. You lose it because someone asked for metal and the system couldn't make it fast enough. And it takes us to the wrong thing. People are saying that this was a shopping spree, a speculative mania, a silver memecoin moment. They're bringing back the old script, Hunt Brothers 2.0, because it worked before. Reuters even put out the comfort blanket. Silver is a death trap. Conspiracy theories everywhere. The meaning is clear. You're dumb. This is noise and there's nothing to see here. But they won't answer this question. If this is just gambling in stores, why is real silver disappearing? This is what they won't say out loud. This wasn't a normal way to look for prices. This wasn't a healthy market finding equilibrium. It was forced liquidation. This was a group of stop-loss orders. This was planned volatility that was meant to shake out weak hands and reset positions. The price didn't drop because there wasn't any demand. People threw away paper, which made the price go down. Someone else was loading trucks while stores were in a panic. See how the crime happened. The amount of COMEX futures went through the roof during the spike. As momentum traders got in, open interest rose quickly. After the crash, open interest fell, and the smash was violent and precise. That's the sign. That's not new sellers entering the market. That means that positions are being forcibly closed. Calls for a margin. Liquidations. The long paper was deleted. This is the part that should really make your skin crawl. While paper silver was being sold, people were taking their money out of the bank faster. Selling paper. There is no more metal. That difference is the crime scene. That's all there is to it. In a real market, money and goods move together. In a rigged one, the weapon is paper and the prize is physical. Now step back. Retail chased the breakout that happened over $120. They bought ETFs. Options, used paper promises. They were told that silver was finally waking up and that it was easy money. What would happen when enough of them came in? Door with a trap. There was no floor. They looked for places to stop. Accounts were blown up. In the meantime, smart money did the opposite. They were there to make a delivery. They took everything out of the vaults. They bought it off the market where the news doesn't go. It's not a theory. It's how things work. Only registered silver can pay off futures. When registered inventory drops by 26% in a week, it means that people wanted deliveries and the system had to give them to them. This is where things start to get weird. China didn't get scared. China didn't go after the green candles. China was paying attention, in a calm way. With time, prices in Shanghai kept going up to $124 and $125 with delivery required. Even though the Western media screamed bubble and death trap, no cash payment, no guarantees, get the metal or don't trade, that difference in price isn't interesting. It's a sign. It shows you where real demand is and where fake liquidity goes to die. They want you to think about the crash, on the red candles. About the fear. Fear keeps you from seeing the vault doors open. Fear keeps you from asking why registered inventories, which are only a small part of all claims, are being drained at record speed. This timing wasn't random, by the way. The crash happened after silver broke through psychological barriers, after retail leverage got stronger, after the news stories went viral. That's when traps are most effective. For those who know how to get it, that is when liquidity is at its highest. So no, silver didn't fail. It was just showing how the system works. A market where a few keystrokes can send billions of dollars worth of paper, while the physical side quietly screams that there isn't enough of it. A market where the price you see is based on derivatives, not the metal itself. And if that scares you, it should. This is just the first act. Do you think this price change is nuts? You won't believe what's going on with the real silver supply behind the scenes. That's the real beginning of the crime scene. When you stop looking at price candles and start following inventory, things get ugly fast. They don't want to see this on the news. COMEX-registered silver fell another 26% in just 7 days. Not all of the stock. Not eligible. Registered. The only group that really backs futures contracts. The silver that can be legally given when someone says, "I don't want cash, I want metal." That difference is the most important thing, though. Eligible silver is just metal that is kept in a vault and could be registered at some point in the future if the owner agrees. It's already promised that silver will be registered. Someone else has it. It is the most important part of the paper market. When that breaks, the whole illusion shakes. This story isn't just about the US. Think about what happened in Asia. The stocks on the Shanghai Futures Exchange went from 462.6 tons to 449.6 tons. A little less than 13 tons were taken out in a few days, in a calm way. No news articles, no tweets of fear. Only metal is coming out of the system. And here's something that Western traders always forget. The Shanghai Gold Exchange only accepts physical delivery. There's no way to avoid cash settlement. You trade and then you deliver. No, here's dollars instead, sorry. That's all. That means that when the stock goes down there, it's not just a trick of the books. There is real metal that is moving. Here's the kicker. Both systems were leaking at the same time. That doesn't happen in a market that is healthy and balanced. That happens when there is a lot of demand for physical goods and a paper casino that is too heavily leveraged. Let's break down that leverage trap in simple terms. There are more than 100 paper claims for every ounce of real silver. The future, options, changes, funds that trade on the stock market, accounts that don't have a name, a lot of promises on top of a lot of promises. The derivatives market is so big that it doesn't even try to match what happens in the real world. That usually works because most people don't want it delivered. They raise and lower prices. They pay with cash. The system will only work as long as no one calls it out. But what happens when more people want physical goods? When enough players say, "No, I want the metal"? The paper system doesn't work. It breaks, and when it breaks, things get really out of hand. That's why the price changes by $30 every day. That's why the price movement looks crazy. It's not chaos, it's stress fractures. Now think about who benefits from that mess. The bad guys come. Banks that deal with gold and silver, JPM, the same people as before, short positions that are very strong and only make sense if silver stays low. When the price goes up too quickly, those shorts are in trouble. So what do? They put a lot of paper on the market. They break liquidity when things are slow. They make margin calls. They force people to sell their things. This isn't a plot, it's just how things are. If you have enough money, you can control a leveraged market. And what about the people in charge? They don't care. This is because saying this means saying that the price isn't real, that the emperor is not wearing any clothes, that the market is a scam to get people to believe in it. The Fed? They win. The dollar doesn't like things like silver that are hard to get. When the price of metals goes up, it means inflation. They scream that they can't trust anyone. Putting them down gives you more time. It's time to make copies. Time to pay off your debts. It's time to pretend that everything is fine. So what do? They do the switch and bait. Let the price go first. Let the price of silver rise to $121. Let the news get better. Let the stores come in. ETFs get bigger. There are more and more choices. Leverage builds up like dry wood. Then hit it hard. The price drops from $120 to less than $90 in just a few days. No more stops. The accounts are messed up. At the worst possible time, retail stores post job openings. People say they were greedy, that they fell for the hype, that silver can't be used as an investment. And right there in that window full of blood, institutions reload. Not as expensive, not as much noise, in person, not ETFs, not paper, metal. You might not know it, but you've seen this movie before. Gold prices fell before the biggest QE program ever in 2008. They couldn't turn on the printer until prices went down. When the world shut down in 2020, the price of silver fell to the low teens. What happened next? An increase of 140%. It's the same thing, a new problem. FTX did the same thing to people's minds, a liquidity trick. Assets that looked like they could pay off debts until everyone wanted to take their money out at the same time. After that, the truth came out. First, they make you scared. Then they take the supply. And right now, supply is leaving Western vaults faster than anyone wants to admit. This is when things get really bad for the West. New York isn't getting any silver. It's not getting bigger in London. It's going to the east. And that metal won't come back once it crosses that line. That flow clearly shows who is winning this power grab. The silver market stops looking like a mess and starts looking like a plan when you stop thinking like a trader and start thinking like a country. This is where the alarms should be going off, so let's talk about arbitrage. Shanghai silver costs between 124 and 125 an ounce. The price of New York spot is stuck at around 180 cents. India is in the middle. The price difference between Shanghai and India is 17%, which is one of the biggest gaps in modern history for a metal that is traded all over the world. If that kind of arbitrage happens, something is wrong. The West is either wrong about how to price risk, or the East knows something you don't. That gap is saying two things very clearly. There isn't enough of something and people are hoarding it in certain areas. If there was a lot of silver, traders would quickly close that gap. Buy it in New York, send it to Shanghai, and keep the difference. Just cash. The issue is that the metal isn't there. Light can move paper. Metal moves as quickly as ships, permits, and politics. And politics just closed the door. Now connect this to the secret buyer that no one wants to see. China doesn't send out press releases about stacking metals. Central banks don't tweet. They keep things. In a calm way, in a planned way. And not too long ago, China changed the way it thought of silver as a strategic resource. That's not a headline, it's a sign of a policy. When something is strategic, it is more than just a good. It becomes a matter of the safety of the country. What about things that are sent abroad? Locked up. Only 44 companies that the state has approved can get export licenses. That is to say, silver will stay in China unless Beijing wants it to leave. And then there's Zhongkai Futures, which is one of the biggest companies you've never heard of. People say they made $500 million in profit during the silver crash. Consider how. A short paper about the smash, while getting physical on the other side, that's the classic move. Use volatility as a tool, make stock out of chaos. Candles follow retail. Institutions want to be in charge. Now watch the policy changes in all of Asia, not just China, to make sure it has enough EVs, solar panels, grid infrastructure, and defense tech. China is stopping exports. Silver is what makes electricity work. You can't go green without it, and you don't let that supply chain be open to price games from the West. India also saw this coming. The tax on silver imports went down from 15% to 6%. That's not being kind, it's being in a hurry. They want money that is legal to come in. They want metal to come into the country, not go out through black markets. India knows what silver means in terms of money, culture, and business. They're getting ready for a time when there won't be any memes. And what about the West? Still acting like silver isn't real. Still calling it a Reddit trade. Still pricing it like it's just another industrial input instead of a dual-use metal that can be used as money. Their laziness is costing them a lot of money. Now let's take a step back and look at the supply chain war. Every year, about 813 million ounces of gold are mined around the world. It seems like a lot, but for the past 6 years, demand has been higher than supply. This isn't just a one-time problem. Since 2021, there has been a structural shortfall of about 820 million ounces. There is a whole year's worth of production that is missing. And here's the hard part. The amount of silver available isn't flexible. Most silver isn't mined on its own. It comes from mining copper, zinc, and lead. It's not as easy as flipping a switch to make more when the price goes up. What if people stop wanting copper? The amount of silver available gets even smaller. There isn't a quick fix. There is no miracle with shale. There is no just ramp up production fantasy. The West is messing with paper prices, but the East is putting real-world limits on things. This is where silver's role as a quiet and dangerous replacement for the dollar comes in. Silver is more than just a metal used in business. It's money with a purpose. It holds both power and trust at the same time. Because of debt, deficits, and constant issuance, trust in the US dollar is fading, and hard assets are taking the hit. Gold does it with a bang. Silver does it quietly in the supply chain. China knows this better than anyone else. Just because the dollar isn't the main currency anymore doesn't mean a new one will be announced right away. It means getting the things you need to make other systems work. Metals, power, the infrastructure. Speeches can't take the place of a reserve currency. Instead, you use leverage. And silver can help you get ahead. When trade happens outside of the dollar, like when energy, tech, and manufacturing move around, the countries that own the resources make the rules. The price doesn't matter anymore. The most important thing is availability. It's not a coincidence that silver is flowing east and stocks are running low in New York, while premiums are going through the roof in Shanghai. That's a shift in power, and this is the part that most people don't see. The goal isn't silver itself, it's the sign. You can see what's going to happen in the bond market. You'll see that silver isn't the point, because everything goes wrong when bonds break. They hope you don't connect this big bomb to silver. The US debt is now over $35 trillion and keeps going up like it wants to die. How about Japan's bond market? Not going well. The Bank of Japan owns so much of it that it's hard to figure out the price. Yields are a policy choice, not a market outcome. There is $300 trillion in debt in the whole world. This is all based on the shaky idea that interest rates will always be low. This is the problem. Rates can't go up without going down. Governments can't pay their debts if rates go up. Banks go up. Houses break down. Derivatives go up a lot. If rates stay low, inflation will ruin the system. There is no simple way out, no easy landing. It's just different kinds of hurt. The doom loop in the bond market has already started. Now, pay attention to what the Fed is doing, because this is where the trap closes. They have three options: print, get angry, put down. That's it. There is no fourth door. They can print to limit how much they get. They can inflate to make debt less valuable in real terms. Negative real rates, capital controls, and temporary restrictions that never go away can make it hard for people to save. Every historical cycle ends the same way. When trust is lost, the value of hard assets goes up. Not because of hype, but because promises on paper don't mean anything. This can happen even if prices don't go up too much. You just have to get people to believe that IOUs are not safe. And this is why silver keeps coming up in connection with the crime. The system is broken at its core. There are more claims than things, more paper than real life. Stocks were used as collateral again. 10 times bonds were promised. At the same time, 100 people own metals. Silver shows the lie because it doesn't behave like an entry in a spreadsheet. It needs to be delivered. People use it for work, and when you use it, it goes away. You can't print it out. You can't rehypothecate something that doesn't exist. You can't keep rolling delivery when your stock is running low. Silver makes things settle, and settlement is the opposite of leverage. That's why they break it. That's why volatility is so bad. That's why price movement seems strange. The market isn't broken, it's under a lot of stress. It's screaming because it can't keep all the promises it made. Let's talk about price now. Not hype or moon talk, but structure. Silver doesn't act like a stock. It doesn't follow the rules. It compresses and then breaks expectations. Long periods of boredom followed by violent price changes. You get fake outs, smash, crashes that are planned and feel personal. What about those smashes? They're not failures. They are places where people who know what's going on can gather. The floor rises every time the paper breaks a little bit. Expect more ups and downs. Get ready for more stop hunts. Expect to see more headlines saying silver is dead right before it rips off people's faces. That's how this market works. Silver doesn't go upstairs. It can teleport. It won't ask analysts for permission or wait for everyone to agree when it goes. It never has. That brings us to the part that no one wants to say out loud. This isn't about getting a quick return. This is about leaving systems that are mathematically doomed, getting out of counterparty risk, getting rid of the idea that a promise is an asset. That means leaving banks that freeze withdrawals for your safety, out of paper metals that turn into cash when delivery is hard to do, out of IOUs that are based on trust and footnotes, and into things that don't need permission to be, having it in your hands, taking care of yourself, things that are real and can't be turned off. When stress turns into panic, the first thing that goes is access. Markets don't close in a nice way. They take over. They leave a space. They keep you out while experts explain why it had to happen. The metal is gone when the story changes. Most people ignore this last warning until it's too late. Silver won't make you rich over time. It's here to show how quickly things can get bad. When paper lies fall apart, all you have left is what you can hold. Putting money into silver is not a good idea. It's a way out. Keep this in mind. Markets don't warn you, they put you to the test. Things that are written down can catch fire. Things on a screen can disappear. But what can you touch? No Fed can do it. No bank can stop it. Silver has already done what it was supposed to do. It showed the truth. You need to decide now. If you want to stay alive in the system, good luck. If you want to stay alive after the system goes down, don't trust things that are written down. Understand what the real world is like, and don't take this warning lightly. Because this move is done, there is no buy the dip. There is only regret.